Hey, this is Charles Mizrahi. For the next 2 weeks, I'll be sending you these videos out of the country. I'm visiting my family, my daughter in Israel, who's hopefully going to give birth next week or so. So I'll keep you updated. And during the time I'm in Israel, I'm also going to be visiting a couple of startups and some amazing technology companies that a couple of people set up appointments for me. So I'll get back to you on that, but really, really exciting things happening here. So, okay, today I want to talk to you folks about something really important. And most people don't talk a lot about it because they think it's negative or they just want to focus on the positive or whatever, and that is bear markets. Folks, investing in the stock market, bear markets are part of life. You cannot be an investor and expect never to have downturns. That's just the nature of the beast. Because let's face it, if stocks didn't go up and down and have volatility, then everyone would be investing in them, making an average of 8%, which they've made since last 100 years or so per year. You can't get great returns like that as opposed to a treasury bill, which on average earned about 2% or so. You can't get those kind of returns without volatility. Volatility is the price we pay for high returns. That's it. And if you don't worry or focus on the volatility, it doesn't really matter. You could still live life and have great returns and enjoy things. So today I want to talk to you about the two things in a bear market that most people don't get, or maybe if they do get, they get wrong. First, I want to take a step back. Bear markets. Bear markets are one of the terms Wall Street uses. Bull markets buoy stocks up by their horns, and bear markets growl them down. That's the only, I don't know why they came up with those animals, but so be it. Now, there's a saying, when the bear comes to Wall and Broad, it doesn't care what it's eat. Wall Street and Broad Street, because on that corner is the New York Stock Exchange. When the bear comes, doesn't care what he eats. First, the bear starts eating or destroying the prices of story stocks. Those are the Pelotons, the Carvanas, and those kind of companies that have great stories, very little, if anything, in profit. And then the bear just knocks them down because there's no valuation under them. They're built on hopes, dreams in the future. After the bear is done eating the story stocks, he then goes for the quality companies, the Microsofts, the Googles, the Amazons, quality companies making oodles of free cash flow, amazing earnings, because when the bear comes, he doesn't care what he eats. Eventually, the quality companies. Now you look and say, Apple's down 20% or Google's down 30%. What's wrong? Nothing's wrong. Remember, the stock price tells you nothing about the business. Looking at a stock price, you would have no idea what the business is, does, or what it's worth. That's why we figure out the valuation of the business, then see if the stock price or Mr. Market has it right or wrong. Now, we're at the stage now where the bear is eating quality companies. Look at the companies in our Alpha Investor portfolio. There are solid companies with major domination in their industry, and in addition, earning oodles of cash flow. Yet Mr. Market is chopping these down 20, 30%. Why? Because that's the nature of a bear market. Now, here are the two things. There are two things you can do to make money in a bear market. One is to be an investor and continue to buy. Two is try to short the market. Now, let's do number two first. Shorting the market is betting or speculating that stock prices will go down. So you sell a stock, I don't want to get into how that works, but you sell a stock and buy it back later. Now, the most you can make shorting a stock is 100%. So if you sell a stock at $10, hoping it goes to zero, and it goes to zero, the most you make is 100%. What's the most you could lose? The answer is, how high is the sky? The answer is infinity, theoretically, because the stock price could go up 100, 200, 300, 400, go up zillions of dollars. We saw that last January during the meme stocks when they were rising. In fact, it destroyed Melvin Capital, a multi-billion-dollar hedge fund that was short these terrible companies, yet the price kept driving up higher by traders who were moving it up. And as the old saying goes, I think it was attributed to Daniel Drew in 1870s on Wall Street. He that sells which isn't his'n must buy them back or go to prison. So we had all these short coverings. I don't short, well, maybe I shorted once in my life, once for a day or two, and it was terrible because knowing that you go to sleep at night, knowing that your loss could be theoretically infinity if the brokerage firm, if you want to keep, feeding the market, because every time the stock goes up a certain percentage, the brokerage firm will call you for more money and you have to keep feeding. If you don't, they sell out your position, you have a devastating loss. The second thing is to buy. And what companies do I recommend buying? And those are companies that are quality companies, the best of the best, having earnings, having cash flow, having record sales, competitive advantages, dominating the markets. Because what happens is the stock price is here and the valuation is here. And what happens let me just reverse that. Sorry. The stock price is here and the valuation of the company's here, and it keeps going down. The stock price, the valuation of the business doesn't change. So there's a huge amount of money to be made here. It only requires patience. That's the whole point. You need time for the bear market to leave, and it's usually on average, bear markets last around 10, 12 months or so. Now, one thing many of you sent in questions about is, hey, Charles, I'm fully invested. What should I do? I can't invest anymore. I can't buy anymore. What should I do? I'm watching my stock prices go down. Answer is nothing much to do. Don't watch your stock prices go down. Don't open your brokerage statement. Don't go online 2 times or 3 times. It doesn't matter. If you owned a dry cleaning store, you owned a hardware store in any town, USA, on Main Street, it was a fantastic business run by great managers. You were an absentee owner and they had a competitive advantage. Are you asking every day, what's the sales? You own a house. Do you call up your broker, your real estate broker every day and say, what's the bid on the house? What's the latest sale? Ridiculous. But we do this in stocks because there is constant stream of financial data on it. What I'm saying to you folks is ignore it. So let me wrap up here. Number one, when the bear comes to Burrard and Wall Street, doesn't care what he eats. So great companies, terrible companies, they all fall the same. Number two, it's how you react that makes all the difference. If you panic and sell, you're done. If you want to try to make money in a bear market, which I highly, highly, highly don't recommend, because over time, stocks just soar to the moon. If you look at the GDP of the United States over the last 250 years, it continues to go, and you never want to short that. So if you want to short the market, your losses could literally be infinity. There's no stop to your losses. Best thing to do, enjoy life, own quality companies, because eventually there'll be blue skies over, the white cliffs of Dover, just you wait and see. And until we speak next week, this is Charles Mizrahi. Thanks for watching.